Bitcoin, a digital currency we've all heard about, a new age of monetary investment to some, a paradigm shift in asset generation to others. It's no question why the appeal of Bitcoin has captivated many to invest in its success. It boasts a powerful movement to the establishment of centralized currency, and we're seeing more and more businesses, along with retail investors, purchasing this digital coin. However, there's one huge issue that cripples its entire potential. Whether you're an investor or you're an advocate for legitimizing it as a currency, you need to understand the underlying flaw that burdens Bitcoin. But to understand this critical impediment, we first have to understand how Bitcoin actually works. So let's start out with an analogy. If you've heard of Bitcoin, you may have heard of the term blockchain. And like the name implies, it's a list of blocks or groups of transactions connected to each other in chronological order. Imagine a block like a mixed up Rubik's Cube. In order for things to make sense, we have to solve the Rubik's Cube. So there are thousands of computers mining or solving these Rubik's Cubes. Once a cube gets solved, those who solved it are rewarded with a prize. This incentivizes growth of miners as they're given currency for their efforts. Now, there are many miners trying to solve these blocks, and only the first to solve it gets the reward. So this breeds a lot of competition to solve the blocks the fastest. This is good because it means more processing power is put forth to solve these Rubik's Cubes. However, this brings us to our first problem, and that's cost. Let's imagine a single block as a travel bus where people or transactions are permitted to get on. Now, people can come up to the bus at any time, but that doesn't necessarily mean the bus has to let them on. In fact, the people that just happen to pay the bus more money cut in line and get on first. This can cause a huge bottleneck in transactions, as those that don't pay enough get neglected until there are fewer of them to get processed. Now we have rising costs because if you want to get on the bus in a timely manner, you need to compete for your spot by putting up more money. But the issues don't just stop there. You see, this becomes a problem due to the fact that Bitcoin's block size is only 1 megabyte. That means on average, a block only contains about 2,000 transactions. At the current rate, it takes about 10 minutes to solve a block, which means Bitcoin is only processing about 3 transactions per second. So essentially, our bus is the size of a sedan, and we're trying to take home all the people who went to the Super Bowl. How exactly does this relate to the real world though? Well, this brings us to the crux of the system, and the reason as to why Bitcoin has this huge problem and is a failure. See, if it's trying to be adopted as a currency to be used ubiquitously, it can't take 10 minutes, 10 days, or 10 months to complete a transaction. You can't expect people to go to the store and try to purchase something only to have to wait for a few minutes for the transaction to clear and the seller saying, all right, here you go. The world doesn't operate like that. Banks and credit card companies remedy this by having instant transactions. They essentially act as a middleman to provide liquidity, which makes their transactions immediate. Bitcoin doesn't have that middleman. It operates in the confines of the blockchain, and until this issue is solved, we really can't view Bitcoin as a legitimate form of currency. It wasn't designed for the large load of transactions that it's now seeing due to its popularity of being the first cryptocurrency. But really, that begs the question, is it even able to be fixed? There's been a long debate on whether to increase the size of the blocks in Bitcoin's blockchain to accommodate more transactions at once. The time it takes to solve these Rubik's Cubes is not dependent on the block size. What is dependent is the literal size of the blockchain that gets much larger when we make the blocks bigger. Since everyone solving these Rubik's Cubes has to download the entire history of the chain to do it, that can be a cumbersome amount of data. The debates have gone on for a long time, and what's happened is that those in favor of increasing the block size have just decided to fork and create their own currency. Thus, Bitcoin Cash was born. But this video isn't about Bitcoin Cash because it's not nearly the giant that Bitcoin is. So disregarding actually changing the blockchain, is there a way Bitcoin can fix this problem? Well, there are people trying to figure this out. The Bitcoin community has come up with what's called the Lightning Network. It boasts both speeding up transactions as well as reducing the costs. But at what cost? Well, it works because it doesn't really use the main Bitcoin blockchain. It acts like a higher layer where people can move money without it affecting the blockchain directly. It does this by not needing the established proof of work on which the blockchain works. You see, each transaction needs to be verified on the blockchain and confirmed by multiple sources to actually be considered a completed transaction. The Lightning Network skips the verification process and instantly confirms the transaction. It does this by opening what's called a channel between the buyer and the seller. Each side puts into the channel the specified amount of Bitcoin for the transaction, so long as both parties have the appropriate funds. Once one side wants their transactions to be cleared, they can choose to close the channel and the transactions get submitted as one transaction to the blockchain. So this is the solution to the problem, right? Well, not exactly. You see, there are even some flaws to this Lightning Network. The network creates nodes which can be run by any computer. Buyers and sellers don't have to be connected directly, but can be connected through any open route to one another. These nodes act as a gateway between parties to facilitate channels. However, since the nodes act as a gateway, they have to always be online. This always online nature, combined with off the main blockchain, can make it susceptible to malicious attacks. If a lot of channels were to close at once, it can cause a congestion where a malicious hack or attack can prevent participants from getting their money back fast enough. The Lightning Network also doesn't really solve the cost problem either. It costs a fee to open a channel, but it also costs a fee to route transactions through the network. The routing fee, while small, disincentivizes people from setting up nodes, thus hindering the network. So really, we still don't have a solid solution to this Bitcoin problem. The community is attempting to solve it with many different approaches, but we have yet to see a completely robust answer. This seems like the last step in transforming what used to be a neat little collector's item into a robust transactional system with real-world use cases and global acceptance. One day, I hope to be able to use this currency to buy whatever I wanted, but until we see these issues resolved, it's still just a dream. Now, as a full disclosure, I do own Bitcoin. I think it's a great investment, but I just don't think that it's at that transactional level that we're expecting to see. Thanks for sticking with me until the end. I appreciate your view and your feedback. Please hit the like button. It really does help me get noticed on the YouTube algorithm. And with that, I'll see you guys in the next video.